credit score is so much more than just qualifying for a specific line of credit. Having a good credit score is important because this can help you to get like good insurance rate. It can help you get like lower interest on your bigger loans, and it can also help you with renting. So it is super crucial to always maintain a higher score. So in today's video, I'm going to be going over 7 lesser known things that can have an impact on your credit score. So the 7 things that I'm going to share today will rank from minimal to substantial damage to your credit score. So if you are new, my name is Agnes. I'm here sharing my journey to financial independence, and for my returning subscribers, welcome back. And please, if you have not subscribed, please do subscribe. And so without wasting any more time, let's get into the video. So the first thing that I want you to be aware of that can decrease your credit score is having multiple cell phone contract or cell phone account. So I've seen people that have that take on cell phone accounts for their entire families, for their aunts, the mom, the sisters and brothers. But now the thing is, when these cell phone contract companies do inquiries on your credit report, some of them might do a soft or a hard inquiry, and these inquiries will stay on your report for up to 2 years. So the damage this does to your score is not as bad. It's normally very minimal. It takes just a few points away from your score. However, when you have multiple accounts, when you take out multiple accounts in the 2 years, then those will add up and can decrease your score. So just be mindful when you're taking out those accounts. The second thing that can decrease your credit score is asking for a credit limit on an existing account. So same thing with the cell phone inquiries. This can be a soft or a hard inquiry. So what you want to do is whenever you want to ask for a credit increase, you just want to find out first from your credit provider whether they do a soft or a hard. So if they do a soft inquiry, that's fine. It won't affect your score as much. But when they do a hard inquiry, then that can decrease your points. The next thing is opening an account at a different financial institution. So let's say you have a credit card with FNB and you want to apply for a loan. I would prefer, personally, I would first start by asking FNB for the loan before I go to another financial institution. The reason for this is because FNB knows already my habits on how I'm paying my card, on how I'm paying my credit. They might do a softer inquiry instead of them doing a hard inquiry. For me, whenever I have an option to get a second type of credit from the same financial institution that I'm already with, then I'll go for that one than going to the next than choosing a different one. Okay, so the next one causes more direct damage to your score. This is not using your credit card. So what can happen is that if you don't use a credit card, the card issuer might close the account due to inactivity. And when they close an account, now this will affect your score. Closing accounts will increase your credit utilization. I'm going to go in depth with in this in the next point. You want to find out from the card issuer whether they do close account due to inactivity. If that's the case, then you just want to put a reminder maybe once a year or once every 6 months to use that credit card or that account to prevent it from being closed. So the next thing, this one causes substantial damage to your score. This is you personally closing your account. Now, we don't want to close accounts. There's 2 reasons why we don't want to close accounts, and this might sound a little bit counterintuitive because, like, why should I keep an account that I'm not using? But here's the reason why you should. Reason number 1 is because when you close an account, you increase your credit utilization. Remember, your credit utilization is the amount of money that you've used across all your credit line divided by the total credit that you had allocated to you. So when you close an account, that score will go up because the total number will decrease, and then this will result in you having a higher percentage. And we don't want to have a higher credit utilization because this shows that we are dependent on credit. The second thing is pertaining to the age of the account. Remember that an older account on your report increases your score because it shows that you've been using credit for some time, for a longer time, and you are reliable. So you don't want to close credit cards if they're not costing you anything to keep it open. Then you don't want to close it. You want to leave it open because the longer it's there, the higher your score. And then the last thing that will also cause substantial damage to your score is financing a new item. Let's say you take your car for repair because you need an engine repair or service or servicing your car. Let's say it will cost you 1,000 rand to service your car, and you do not have that 1,000 rand on hand. They can offer you that 1,000 rand in form of financing to cover service. And if you take this, then it shows that you've maxed out your credit limit, because this financing is a type of credit. So it will show that you've maxed out your credit. When you use all the money from the credit, then your credit utilization goes high. When you finance items, this causes an increase in your credit utilization. Since you had no money to pay, it just shows that you're dependent on credit. You wouldn't have been able to fix this if you did not take the credit. And with this, they even give it to you at a higher interest based on your current credit score. Let me know if there's any other thing that you've experienced that has caused your credit score to go down, and so that we can learn from each other. Thank you so much for watching. If you did not subscribe, please do subscribe.